All right, guys, this is being recorded. One thing I say at the beginning of all these webinars is watch this again. The reason why is because if you're new to options, there's going to be stuff that flies by you in this. And even if you're a savvy trader, I'm going to throw some things in there that you guys probably may have not heard anywhere else also. So especially if you're a newer trader, though, watch it again because, for one, there's going to be a lot of nuances. We're going to be covering a lot of stuff in this. And the second time through, it'll really sink in. This is going to be a relatively easy strategy to learn. Don't get me wrong. So we put this in the beginner because it's so easy to learn, but it does come with a little bit of higher risk tolerance and lower probability of success. So just like with buying a stock, it's a lower probability of success, despite the fact that the market's gone up several years in a row. It's still basically a 50-50 shot on when you're buying a stock. So that's what we're going to be looking at for probabilities. And this is going to be creating a synthetic long stock position. Now, the beauty in this is it's going to use a lot less margin and you're going to get the same performance. Saying, for instance, if the stock goes up $1, you're going to gain $1. If the stock goes down $1, you're going to lose $1. So we're going to be building this as close to a one-to-one relationship as we can. Sometimes it's going to be off by 1 or 2 pennies, if you will. If the stock moves up $1, we might move up 98 cents. But at the end of the day, for all the less margin that we get to use for this position, makes up for it for sure. Anyway, let me get a couple of things out of the way real quick. My name is Eric Wilkinson. Some of you guys may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. I started trading in college with some money I'd earned, and then trying to get a psychology degree, decided about a year into my trading that psychology may not be the right path for me, so I switched it over to finance. And then after graduating college, I moved up to Chicago Board of Trade, or moved up to Chicago to work on the Board of Trade. I started out as a runner, sold all my stocks, jumped into the pits, and bought myself a badge. I've been trading, my own money ever since college. So still here, still doing it. But in that time, I've traded everything from stocks, financial futures, commodity futures, currencies, and options on all these products, basically in all market conditions. I've seen several 600-point down days or up days for that matter. And I got to go over this disclaimer. Any opinions, news, research, and analysis or other information provided by ProTrader Strategies and associated companies is for general commentary, does not constitute investment advice or solicitation to buy or sell any of these securities or strategies. At the end of the day, what this is dead on, you guys. And the reason why is, for one, liability. Two, the other is, I can't go out there and specifically say, hey, this strategy, we're going to put on the synthetic long stock position in XYZ and everybody should do it. No, I'm not that person that goes that route. What I'm going to do is teach you the right situation for a particular strategy, and then it's up to you guys to take what you've learned there and implement it in your own portfolios. I'm going to give a lot of rules that I've followed over, that I've kind of created over the last 25 years I've been trading, and kind of put that all into a basket to kind of give you an idea when you're trying to come up with a market assumption and all these other things, and there's all these different option strategies you can do. Well, I've narrowed it down for you by picking the right environment and things of that nature for particular underlyings. Are you in a new city? Shouldn't change the cup? I'm still a Chicago fan, though. So I still follow all the Chicago sports. I have all my life. I grew up in Indiana. We didn't have any professional sports, but my grandparents that owned a farm, and we used to go up there in the summers, and I'd spend the whole summer up there. But on the radio was WGN News all the time, and it was all Chicago sports. So I was always a Chicago sports fan. All right, finally, please remember the past performance in any trading system or methodology is not necessarily indicative of future results. All right. You can also follow me on Twitter at Wolfman's blog and follow the parent company at Pro Trader Strat for all kinds of market wisdom from Pro Trader Strat. You may not get the market wisdom from me. It may be more along the lines of snark, but hopefully I throw some nuggets out there for you. Bears fan is unfortunate. Yes, Scott, being a Bears fan is very unfortunate. And you don't want Cutler on your fantasy team because that's even more unfortunate. I had basically the Miami wide receiver core on my team, fantasy team this year, and it was painful. I'm a glutton for punishment, I guess. All right. All right. So the beauty in this, I mentioned this a little bit earlier. Why buy stock when you create a synthetic stock position? It doesn't make sense really, unless you want the dividend or you're in a really long, this is going to be like part of your core portfolio where you're going to trade around that. Say, for instance, you like Caterpillar or something like that, and you have a bunch of Caterpillar stock, then yes, you're going to hold that for a long term and collect the dividends and things of that nature. But, I'm a trader, so I don't like to hold anything longer than, a month or two at best. So I like to get in and out of them. And if I'm going to get in and out of them, creating this synthetic stock position is much more useful for me because I can create more opportunities by buying different stocks. If you have, especially if you have 100,000 or less in a margin account or something like that, and you're trying to buy stocks and trade around those, that's going to become very difficult. So it's really easy to do this with the options, and it will act just like the stock, other than you're not going to get dividends. But let me go over a couple of things here. What is it great for? Oversold stocks. If you see a stock or something you just want to buy or because you have a bullish assumption. Another thing is bull markets. We've been in a bull market. Today's correction may throttle that back a little bit. But one of the things I really like to do this for is oversold stocks. And that being oversold stocks, generally speaking, that don't have high implied volatility. Because if they have high implied volatility, I'm probably going to lean towards selling some puts if I have a bullish market assumption. So it does come into effect in that thought process just for the probability aspect. Yes, I'm getting higher probabilities by selling puts, but I don't have the market gain that I would have if I was correct in my bullish assumption. It's going to be much more profitable to set up this long synthetic stock position. And for smaller accounts, like I mentioned, if you have an account that's less than $100,000, you should seriously be thinking about adding synthetic long stocks rather than just going out and buying that stock outright. And for newer traders of options, this is a great one when you're trying to get your feet wet. If you've been trading stocks for a long time and you're thinking, you know what, I want to step into those options and play around with those, see how they work. This is a good opportunity to start playing around with that if you're used to trading stocks. So newer traders of options, this is definitely one that you guys will understand a little bit because it's going to act dollar for dollar like a stock. When the stock goes up, so does your profits. What do you mean by oversold stock? Indicators, price. Trevor, great question. I usually look for like a 10% or more correction within a short period of time. I'm not talking about like a long trend, but we'll look at a couple that I've kind of vetted that have had some moves that may not necessarily be the direction they end up going in the future. I think there's a couple of them that have had a couple of major moves in the last few days, and I think it's a little overdone. That's where I kind of step in. But keep in mind, when I say oversold stocks here, I am a contrarian by heart. So I'm always looking for that reversal or that turn. So that's kind of me. That's the way I trade. But I always think there's going to be a little bit of bounce, especially when there's a big correction. So that's what I like to put this on in. And if you've ever had a bad habit of not selling when you should, I am guilty. Well, that is true. And we all have that tendency. But you know what, LM, what I say when one of the rules that I have for myself, and I have like 5 spiral notebooks sitting right here on my desk. When I put on a trade, I write down the trade I put on, the date, or I put on the date, the underlying, the trade I put on, and then I put in there why I put it on. What was my thought process to give me this market assumption? And then I also write down where I expect to get out of this trade and write that down. The reason why is because you will be more mechanical if you write it down than if you have it in your head. If you have it just in your head, you guys, you're going to get to that point where you said you were going to get out and you're going to try and squeeze it out a little bit more. And yeah, there's going to be times where you've made that right decision and it goes the right direction, but there's going to be several of those times where it goes against you, and those times it goes against you is going to hurt worse than the times that you actually made a couple extra pennies by squeezing it out. So just write it down where you're going to get out, stick to it, and then move on with your life. You know, you've accomplished that. You hit your spot. You said you were going to get out. That's where you get out. Stay mechanical. How do you select stock candidates for a synthetic long stock? A lot of different ways. A lot of times I just go through the charts and look for something that has had a major move or news. If I see something come out that somebody has, the one thing that's coming to my mind, and I actually went out and bought stock in this company, but it was back in the day when Yoplait came out with the yogurt drinks. Now, I don't know how you feel about yogurt drinks, but I like them. But more so, I think it's brilliant because what they did is they took a cup of yogurt and added a bunch of water to it, split it 3 ways and made drinks and charged the same amount of money. I mean, you talk about thinning out your product and making more money. I thought that was brilliant. So something like that, like if you see something, somebody comes out with a product, or you see somebody doing something that may be earth-shattering, for lack of a better phrase, and you decide you want to buy into that company, well, you could do that with the synthetic stock if you thought there was going to be a bump. Now, if you're looking at really long-term and you're going to hold this for 10 years, then this isn't the right strategy, obviously. If you're looking at something, over a year even, I would probably lean towards buying the stock and just letting it ride. But this is for, market moves like the oversold stock position. I'm looking for something that's kind of come off a lot and looking for a bounce. And I'm just looking for that little bounce to make some money. And with synthetic long stock, you can make it dollar for dollar. So it makes it pretty good. I don't know. Yeah, we'll look at Priceline, something like that. Chen, I'm going to, once I get through all these slides, we're going to pull up the platform and I'm going to throw it out to you guys to give me some examples and we'll run over those. All right. All right. Great. Do you have a percent to get out? Do you use I don't, I'm not even going to try the clouds. I don't use those clouds usually. I do have a couple of things that I do use. But usually I'm looking at Fibonacci support resistance levels. That's what I kind of do. And we'll go over all that here in a minute. All right. So your risk reward is the same as a long stock position. You're going to use about 75% less capital. Now that's if you bought the stock outright. Now this isn't buying the stock on margin. If you buy the stock on margin, then it's about 25% less capital than even buying the stock on margin. As you can see, that's still quite a lot of margin saved by using the long stock position here. All right, your return on capital is much better. If you're using less capital to buy the same thing and you get the same result, well, if I used less money to do this for the same exact result, our return on capital, which is what we put up to do this trade, is much less, and that makes that return on capital higher. All right, building a synthetic long stock position. We're basically buying an at-the-money call and selling the same at-the-money put. That's the same strike. Very easy, right? We're buying a call, we're selling a put, and in the same strike. Same strike, same option montage, same expiration, all of that. Do I ever use an OCO with a stock versus the synthetic? Is that what you're asking? All right, keys to success, picking the right underlying. Remember, in that options montage, we need to have something that has tight bid asks. So XOM is something that I actually sold some puts in because it has really high implied volatility, and I'm bullish in these energy stocks. So I was really surprised they came off that much, especially when they beat earnings. Just a little soapbox, just to tell you what I've got, full disclosure, I guess, for lack of a better thing. But I do go out about, somewhere between, 90 and 100 and some odd days. So I'm going to probably look at these June here. For this, that I got a little ahead of myself. Sorry, you guys. This is for picking the right underlying. So picking the right underlying, what we need to find out is if I was bullish in XOM, I need to go into the monthlies that have some of the nearest expiration, and I'll just quick on the 42s because this is usually where I look. And you want the bid offer to be 10 cents wide on this. So anything under $100, somewhere between the bid and the ask, needs to be less than 10 cents wide, okay, on this option montage on the about the 35, 40 days to expiration is usually where I look. So these should all be within 10 cents of each other before I'm going to start really trading options around this. If it's over $100 stock, say for instance, let's just look at the Qs because they're right there and it's over $100 and it's an ETF, but I'm just going to say stock anyway. But it's $100, over $100. So basically my rule for this, for the right underlying, is move your decimal 3 ticks to the left. 16 cents wide is where they should be. And these are 16 cents wide. So that fits that rule. That works out. That means I would be able to trade these options. So that's the rule of thumb. Under $100, 10 cents wide on the bid ask. If it's over $100, if it's $1,000, you move it 3 ticks to the left, they should be $1 wide. And it comes in pretty close to that, you guys, on the good ones where there's a lot of volume and open interest going on. And that's what we're looking for. The reason why we need that is because if we get this directional move, you can see the options that get deeper in the money are the ones that get a little wider. And if we're in a stock that has like 50 cent wide, let's say it's a 50 or $100 stock and the bid ask is 25, 50 cents wide, okay? Let's just say 50 cents wide to give a extreme or more extreme example. As soon as those calls go into the money, we're directionally right. You can see how wide the bid ask gets the deeper in the money they go. And that is going to make it more difficult to give out. You're going to have to give up more edge to get out. You don't want to give up too much edge because you don't want to give up a lot. You're going to probably have to give up some intrinsic value, but you just don't want to give up too much intrinsic value. So whenever your calls go in the money, always check over here on the puts at how much extrinsic value, that's the theta decay that there is. And you don't want to go too much less than that because then you start eating into your intrinsic value, which is what these stocks are worth. If you're selling the stock, the 145 or the 149 calls out, you wouldn't want to be, or let's just do the 150 calls for easy math. The 150 calls, okay, have about 90 cents in extrinsic value. I wouldn't want to sell these for much less than, $15 because this is trading 16 or 164. So the difference is about $14. So you wouldn't want to start eating into that, okay, to get out. So play that as well. But the deeper in the money you go, the wider it's going to get. And if you started out wide here, it's going to get even wider inside of here, okay? So make sure you don't make that mistake, okay? So 10 cents wide, under $100, and move the decimal place 3 ticks to the left if it's over $100. Do I get out at the market or a limit? I usually go higher than about mid-market and start ratcheting it down, okay? And I go to a point where I don't think I'm going to get filled, and then I start slowly moving it down. Now, I'm not saying I wait like 10, 15 minutes. If I decide that it's the time to get out, I put it in higher than I think I can get filled, and then I move it down, or, I hit the cancel, replace, send it out there, go back to my main window, look at it, cancel, replace, and I just start adjusting it until I get filled. And the reason why is because there's actually tighter markets in a lot of these underlyings than you're actually seeing, because there's different spreads that you can't see necessarily and things of that nature that are leaning on outrights that are going to try and auto leg, is what we called it on the floor. It's going to spread into that. So always ratchet it down from where you don't think you're going to get filled to where you think you should be filled, and then stop there, which is usually right around mid-market, I would guess. Yes, Wally T, Wally E, we will be sending out a recording after this. This is being recorded, so definitely watch it again. Picking the right strikes. Now with this one, what we're trying to do is with this synthetic long, and I'm just going to stick with whatever I have up here, QQQs. With the synthetic long, I like to go with buying the call that's slightly in the money, and then selling the call that is selling the put that is slightly out of the money, kind of like that. That's usually my go-to. I just have this thing with having the puts out of the money. Those are the ones that are going to decay, right? And so I want to kind of start with those just out of the money. These are the at the money, quote unquote, at the money strikes. But if we look at the 124 calls, you can see the 124 calls are in the money by 61 cents, and the puts are just out of the money by 61 cents. Okay, you see that difference? So 164 doesn't go to the pennies. It's just leaving that out. So these are the at the money calls and puts, but we want to get really technical. This one is slightly in the money because we're higher, and this one's slightly out of the money. And that's just the way I do it. But the thing we really want to do is try and build this out to make sure that our deltas are 100. So when we go out and buy 100 lot of stock, that 100 lot of stock is equal to 100 deltas, because if the stock goes up by $1, we go up by the amount of how many we own, which is 100. So we would be up $1. Same thing with this. If this underlying goes up by $1, these calls will increase in value that first dollar by 53 cents. Vice versa, these puts are going to decrease by 47 puts. Okay? So those, this is going to decrease by 47. All right. And that's what we want. We want these to decrease and these to increase as the market goes up. All right. But we want these deltas to add up to 100. Now, keep in mind, we're just dropping this negative in this scenario, but 53 plus 47 is 100. That means we are going to be long 100 deltas if we do this trade as a one lot. For every one lot, that's 100 deltas. And then, if you increase it to that, for every dollar the underlying increases, you increase by $2. Does that make sense? So the P&L is the same as a long stock with selling the put and buying the call strike above at the money. Yes, it is absolutely the same P&L. It's, as a matter of fact, if we go and look at this, let me change this actually to a one lot. We'll look at this on the Analyze tab, hopefully. So you can see there's a little purple line underneath there. That purple line is actually the stock. This blue line is the risk reward on the options. Okay, so they're exactly the same on a chart. Okay, all right, so picking the right strike. The next one is picking the right duration. Because we are isolating. I like to go out about 100 and some days. You can go out as far as you can or as far as you want, because what happens here is we're offsetting this theta component. Like, remember, when you buy an option, theta decays 5 cents a day, and it's going to tick away at this. It's going to eat away, erode. It's the thief in the night that steals your premium when you're buying it. But because our theta on the other side is the same, we're getting a 4 theta as well, or 5 theta, I'm sorry. So those are going to offset. This is going to decay this at the same rate this decays this. So they're going to offset. All right, we want this decay. We don't necessarily want this decay. So those are going to offset because we're buying one, selling the other. They will offset each other. So we're isolating the theta decay component, which is pretty big deal because that allows us to go further out. And we don't have to worry about that theta decay. You can do it nearer term too because you don't have to worry about it. But I like enough time to be right, so I'm going to take advantage of the free time in this one. Okay, so picking the right duration. I like to go about 100 days out. All right, picking the right environment. Now, the other thing with this is we are isolating theta, so we don't have to worry about time too much, but we want enough time to be right. The other thing is, I went into the March for this, I don't know why. But the other thing we are isolating is volatility. So we don't really have to worry about volatility and where it is right now. So, volatility, this could be 100, this is 100 implied volatility percent. Now, what do we usually say? We want to collect premium in those types of situations. So yes, you can do this in a high implied volatility environment or a low implied volatility environment. They're going to offset. So it doesn't really come into, it's not as much of a factor in determining this strategy. Now, if QQQs has 100 implied volatility percent, and I'm going at a 50-50 probability, I'm going to make a lot more money on this, but I think I would rather go and sell some puts for a bullish directional assumption in a high implied volatility market, collect that premium than doing this one. But you don't have to worry about it. I think there's better strategies in a really high implied volatility environment. So usually I'm going to use this one right around that 50 implied volatility percent or lower. That's usually my go-to on this. But if I find an underlying that I'm bullish in, and I'm really bullish in, I think I'm going to hit a home run with it, then that's when I'm going to do this synthetic long. It's like when I think I'm going to have a home run, it's like this stock is oversold on nothing. I'm going to catch this and take advantage of it. I think XOM is like that today. They beat on earnings. Oil's at highs. I think they're just going to continue to stay, above 50, which is good for the fracking guys. Anything above 50, they can really start pumping it out. And the economy is doing well. I think that the oil companies are doing well. And so I'm kind of bullish on XOM. So I might, in that regard, it has high implied volatility right now, but I want that dollar for dollar gain that I think I'm going to be able to get to. So the environment, so what do we talk about? The strikes are pretty important. You want to pick those at the monies, whether or not you pick the in the money put or the in the money call is up to you. I usually like to do the in the money call and the out of the money put, but that's just a quirk of mine, really. Picking the right duration. We don't have to worry about duration because we're kind of isolating that. Picking the right environment. Usually I talk about volatility at this one. And this one, we're isolating volatility, so it's not that important. I do think there's better strategies for really high implied volatility than this because the probabilities are in your favor, and you can still get a nice gain from selling those puts. You don't even have to be directionally right with your market assumption with the selling of the puts. So high implied volatility markets, I'm going to usually steer away from this unless I'm very, very bullish. And then knowing your exit strategy before entering the trade. We kind of went over this a couple of times with you guys. A lot of this is going to end up coming down to your risk parameters. If you have a high risk tolerance, you might squeeze this out for a little bit more. If you have a low risk tolerance, you might be getting out of this a little bit earlier. Write it down. Come up with a action plan on your first couple of trades, or on all your trades actually, but write it down where you're going to get out. For instance, what I will do, and I use the market profile, somebody was asking about this. So when it gets a little overextended to one side or the other, I have a tendency to be a contrarian, go the opposite direction. That's not the end all be all, but that is one thing I'll look at. The other thing I'll likely look at is Fibonacci. I have kind of grown up with Fibonacci, so that's usually what I look at. You know, you can see the support and resistance areas as well, where they kind of top off and sell back off. That's going to act as a support or a resistance, depending on, you know, where we're coming from. So I will look at those. For instance, let's just look at ExxonMobil because I'm bullish on it, and I've talked about it a couple of times. I could throw ExxonMobil up as a quick and dirty. I'm not trying to nail this exactly. So ExxonMobil, I would expect to get back up into this area, I think, or at least come up and test this 23 Fibonacci level, you know, sometime next week. So I would be bullish on this, looking for it to come up and trade that. So if I could get it way down here, then that's where something I would look at. I didn't think it's going to get back up into here, into this trend channel that you can kind of see visually through here. I think it's going to continue kind of rising that way. So, but that's all my market assumption, right? So I would pick something like the, you know, the highs here, which are XOM in the 90s. So maybe I would write down, if it hits 90, I am out for sure, you know, and a test and fail of like the 86 area right here. If it tests 86 and fails, then I would be out, you know. So like write those things down and make sure you keep on that. All right, a couple of questions coming up. Parship, wait, Pelosi says we are facing Armageddon and the apocalypse. What do you mean the economy is doing well? Yeah, well, you ask the Democrats, they are not going to probably say the economy is doing well, and if they do, it's because of, because of Obama. Anyway, would you hold through earnings and avoid earnings plays with this long stock position, synthetic long? No, I do not play this for earnings. This is more of a long term, and you know, like I said, I don't like to go out, hold this for more than 100 days. Usually I'd like to get out of these before an earnings if it was coming up. So we're right in earnings season, so we're going to have to pick something that doesn't necessarily have earnings. But I don't usually ride these out through earnings, no. I usually get out, unless it's, you know, a pretty bad loser, and I'm like, oh, well, you know, there's nothing that can really hurt me now, but it can always continue to go down, I suppose. But I don't usually hold these in through earnings. I have a whole group of strategies and rules in and around earnings season that I like to play, that I have a whole course on that you can check out. What else was there? I think that's about it. All right, so know your exit strategy. One other, let's go over these last couple real quick before I get too long-winded. Risk profile, max profit, it's infinite. You know, any stock, the max profit is infinite. Your max loss is it goes to zero from wherever you bought it. You bought it at 50, it goes to zero. You lost that $50 times however many. That $50 is actually more than $50. It's, if it drops $50, you know, that's like $5,000, because each contract is worth 100 of the underlying. Each one option contract is worth 100 of the underlying. So with this synthetic stock position, it would be like you bought 100 of XYZ at 50, so your risk is $5,000 if it goes to zero. All right, break even is the call strike price minus the credit. I usually like to do this for a credit if I can, or plus the debit, but it doesn't really matter. You're basically pricing it in to where the underlying is trading. Sometimes you can get it a little bit cheaper though. So sometimes, you know, that's another thing on the benefits of doing this as options. You know, if XYZ or ExxonMobil, XOM, is trading at 84.53. Sometimes we can get that stock a little bit cheaper. So 84.53 in this case, we're getting a debit. We're paying a debit, so we're paying 84 or sorry, 164. Why is it? This is QQQ. Sorry. Let me just go back to the QQQs because that's up there. QQQ. All right. So the underlying is trading at 164.61. We're paying 62 cents for it. So we're paying 164.62. So we're paying a penny above here. But if you look at it, you know, bid ask is a little bit lower. That's just the last trade. That's after hour stuff. But you can see we're basically paying what we would pay for the underlying for that. And sometimes you can get a little bit cheaper. What is the advantage of doing it for a debit or a credit? You know, Trevor, I'm that guy that just likes to collect a credit. There isn't really an advantage necessarily. Usually if I'm doing it for a debit though, it's because these puts are out of the money. If I did it for the ones that are in the money, you can see that if I buy this call, sell this call, it's going to be for a credit. So 65 minus the, it's actually minus a credit. So that's actually, yeah. So minus the, so 164.90. So it's definitely better to do the options here because we're getting it at a much cheaper price by almost 30 cents. So check both of them. All right. Does that make sense? All right. So guys, throw it out there on this to look at, and we'll go through my rules. I think somebody had Priceline earlier, but I've seen Alcoa. Do they have any? They shouldn't have any. So they made a nice big move, and clearly I have a really old Fibonacci on here. So let me just remove that. Fibonacci, let's just throw it up there. So I would look at Alcoa. All right, I'm bearish, or Alcoa's had a bearish move, and I could probably even throw up a trend line if I can find it really quick and see what that went down in terms of percent. It looks like it's about 8.4%. Let me just go the other way because then it brings up the box so I can see it. Oh, actually, it's a 15% drop. So that would be a good one that I would look at for, you know, an up move. I don't know a whole lot about Alcoa, but then go over to the options, and we're going to flip into here, go out about 100. I don't know if I want to go 160 days, so I'm going to go to the 70 days here just to speed the process up. Right there at that ID percentile that I was talking about, somewhere between 50, 30 is kind of like where I like this for stocks because there's not a whole lot of option strategies to do right in there that has a market assumption like this. All right, 50 delta here. Somehow we are managing to get more than 50. Okay, so 100 deltas. So underlying is trading 49. This is probably the closest to the at the money. So 55 deltas plus 46 deltas. We're actually getting more deltas than the underlying. Because see, we got 46 and 55. We have 101. So we're synthetically, if we did this as a one lot, doing 101 of the underlying. So every $1 increase is $1.01 increase for us. We're paying a debit of 35 cents. So the debit is 49 plus the debit. So we're paying 49.35. Not a great deal there. So let's just look at this one. So we're going to be buying those calls, selling those puts. We've got 100 deltas, 50 and 50. That's right on. 64 cents we're going to subtract here. So it would be a better deal to do this one because we're getting a 64. So we're basically buying it at 49.36. I can't remember what the other one was, but I think it's better. I feel like the SPY may reverse next week. Would this be a good trade for it? Yeah, Doug, if you're bullish on SPY, then yeah, it would be. What is SPY's implied volatility? You know, if it has super high implied volatility, I'd probably sell the puts, depending on how sure you are, right, Doug? Like if you're really sure, then go with this. If you're kind of like, yeah, I think it's going to go, but maybe not, and it has high implied volatility, then I might do something like, you know, it's at 100 IV%. So I would probably sell puts and just collect that premium for my directional assumption. If you're really sure, then that's when you would go out and do the options. For a synthetic short position, would you buy the put and sell the call option? Yes, you would, absolutely. And we're going to be talking about that next week. If the stock pays a dividend, needs to be considered. Yes, if a stock pays a dividend, it does need to be considered, especially if you're buying it way out here deep where we don't really know what the dividends are. You know, the closer we get in here, they've kind of talked about it, and we've seen their past dividends and things of that nature. So it's kind of priced in there already. But yeah, way out here, they're not. So the calls are the stock will drop by the value of that X dividend date. So the stock will drop by that amount, and that will affect you as well because you're dropping by that amount, right? Do synthetic covered calls make sense to you? Synthetic covered calls like selling a call against this? JQ, is that what you're asking? Because I do something that's called a poor man's covered call that adds actually a synthetic put into it. So that's usually kind of where I go with those. It limits your risk to the downside, but you limit your risk to the upside. I don't usually sell a call against this necessarily because there's I just never have. I've just covered the calls with the poor man's covered put, to be quite honest. But you could go up there and sell a call against this and lower that basis for sure. I have no problem with that. All right, so that's basically what we're doing is setting it up like that. Alcoa was the other one. And if I look at Alcoa for this one, you know, I would probably say for me, I'm looking at where I'm getting in and getting out. You know, it's supported right here on the 50-day moving average, but this Fibonacci level is going to act as support. It's also right here, you know, for me would be a area where it might bounce on. But if it broke below this Fibonacci level, I would be out. And if it went up for me and tested this 57 mark, then that's probably where I'd be out too. I just want to get in and get out of this relatively quickly. Somebody else threw out a couple of stocks out there. I think it was Priceline. So Priceline has really high implied volatility. I don't know when their earnings are offhand. But they've come down, landed right here on this point of control being supported by the 200-day moving average. We're looking for it to go up, throw up a Fibonacci. Actually, that's trend line. Throw up the Fibonacci if I can get it real quick. Do this real quick and dirty. So I'd throw it up like this and say, okay, well, I'm bullish on it. Broke below this. That's going to be, I think it's going to go up and test the value area high, which lines up with this Fibonacci level. That's where I'd get out, probably get out on this Fib area. That's widespread for earnings. All right, yeah, let's skip over Priceline then, because it's going to have, Priceline will meet this rule every once in a while. You know, I said move it 3 ticks to the left, so we're at $1.80 or something like that is what we want for our bid ask. And Priceline will fit that bill quite often. $1.80 on to $6, $7.30 or something like that is pretty close to that. And it generally will during the day session. So it does have wide markets, bid ask, but keep that rule in mind. That keeps you focused. Why do you use a 1-year Fibonacci? Farshid, that's a good question. I just usually look at the 1 year. I usually look at the 1 year for everything. Every once in a while, I'll go out to like a 3-year or something like that and do it. But Usually I just look at the 1 year. Okay, Wally T, let me read this real quick. Why not just buy the long call at a 100 delta? Is it because of the options premium of the delta? One call is so when you're buying that long call, you're putting up, buying that one call or the 100 delta call, you're really deep in the money and you're putting up a lot of margin for that, to be quite honest, because you're paying so much for it. This is going to be less margin intensive on it. If you are short a call and the stock pays a dividend, then you are responsible for paying the dividend. If you are short the call, no, if you are short you're paying the dividend only in the value of your call being less, right? So if the stock goes down and you're short a call, your call value decreases. You aren't responsible for paying the dividend. If you're just short a call and they have a dividend, you don't have to pay that. Only if you're short a call and somebody puts it, sticks you with the stock, right? The rule is if you are short the stock. Yes, if you're short the stock, then you have to pay the dividend. Definitely you have to pay the dividend. If you are short stock, you have to pay that because you've borrowed it. But when you're doing options, you don't have to pay the dividend other than, the stock price goes down. Yeah, it's short the stock. That's the beauty in this, is you don't have to deal with any of that. You also don't have to, with synthetic stock position, especially on the short, you don't have to pay all the fees and everything. You don't have to pay the interest, you don't have to pay the fees and everything else. So you're getting around that as well. On the short side, it's a little bit more messy, but on the long side, you're using 75% less margin, so you can do 3 times as many, right? All right. So another one I was looking at. So we looked at XOM. I was looking at Win. I think is gotten overdone to the downside. I mean, he's been nailed for sexual harassment, but he lives in Sin City, you guys. Do we expect anything different from somebody that lives in Sin City? No, I'm not trying to make light of that, but I think that this might be a little overdone for his stock. I don't think that him being accused of sexually harassing women is necessarily going to hurt his casino stocks. I think people are still going to go there. He's got the best casinos in Vegas, as far as I'm concerned. So I think people will still go there. Win stock is on sale now. It absolutely is. So, I'm looking at getting into this. So this is one of those situations where I was talking earlier, should I just sell puts in this? Because it's got really high implied volatility. It should come out. Should I just sell puts? It's a higher probability strategy. I do have that going on in my head right now. Which is what I would lean towards, but I'm pretty bullish on Win. I think we've consolidated here. I think it's going to kind of, as soon as everybody forgets about it, it's going to start trickling back up. So I'm more bullish on it than maybe just going and selling puts. And that would be my assumption. So generally speaking, with this high of implied volatility, I'm going to be selling a put spread in here, right? Or a put to get that move, because I can be directionally wrong and still be right. But when I'm sitting there going, this is turning around and I think this is going up, that would be a situation where I would discount that necessarily, all right? When you say sell, you mean a bull put. Yes, when I say sell a put, I would sell a put in that situation, generally speaking, because I can get all the way down here to like 150 and collect $1. Where's 150 on here? It's going to be way, I guess it's not that far. It's right to there. So it's a pretty far drop. I don't really foresee it going that far. So, but I would, generally speaking, lean towards selling a put with this much implied volatility in it. but I'm pretty bullish. So, and I know volatility is not going to hurt me if volatility comes out because I've offset that. So we're at 165. I'm going to look to buy this one, sell that one, because check my delta 56, 44, so 100 deltas. And generally that's what you're going to get with the at the money. So one contract, we're looking at 165. I paid $1.35 debit. So that basically puts me at 166.34. So 166.34, if I pay $1.34 here on the 65 calls or the 165 calls, that means I paid 166.34. That's less than, it's quarter less than what I would be paying for the stock. So I'm even synthetically getting long the stock, and I'm getting long the stock at a price that may be unattainable by buying the stock outright. So that would, for me, you know, this market can go down another quarter and I'm still positive P&L. Okay. So that's what we're kind of looking for with these strategies, is to be able to also buy them on even buying them at even a cheaper price than what the underlying is trading. And this is an example of that. If I can get this at $1.34. And the other thing I was talking about is defaulting me right here, or $1.42 to the mid market. Where do I think I'm not going to get filled? Well, if I bought the bid, right, and I sold the offer over here, I would be looking at a difference of a dollar, let's say. Yeah, let's just say $1. Wait, is that right? If I bought the bid and I sold the offer, I would be buying it for $1. So I'd be paying a debit for $1. So that would be the extreme. Like, if, you know, I'm saying 535, just to make my math easier, $1.05 is really what I'd be paying. Buying the bid at 635 and selling the offer at 540. That is, sorry, 95 cents. So I'd start at like a, you know, maybe $1.10. I'm going to have to give up a little bit of edge, but I'd start out with like $1.05, $1.10, hit confirm, send, and then go back, you know, and cancel replace. Maybe move it up like 2 cents, cancel replace. Move it up 2 cents, cancel replace. All right. And then I go through that until I get to about the mid-market. I should be getting filled by that. But usually when you do that, you will find you will get filled before the mid-market, because there's a lot of spreads that are going on in here, you guys. Why I would get filled better is because there's a lot of spreads in here that are leaning on each other. We can't see all these different spreads. So somebody might have a spread where they're trying to do this one, and you know, it's actually $4 bid leaning on these 5.10. So he's trying to sell it for, you know, $1.10 this spread. So, but it's at a different market and it's not able to be shown, so it won't always show up. But when you start doing this, those spreaders will go in there and find out, oh, you're offering this because it's there, and boom, 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 and all of a sudden you'll see all these things start to trade. All right. There's only 2 weeks left on these options. Yeah, absolutely. I would not do that. Good call. Delete that. I don't want that. I don't want to go out 100 days. Sorry, I got stuck in there. So let's still look at the 165 calls. That's what we were using before, right? So if I'm going to buy these and sell these, good catch, whoever that was on the, I would never do that 14 days to expiration. 165, this one's not working out as well because we're paying 165. We're paying over on it. 165, they're not going to give us any love here. 160, $7, so it's a little higher yet. Buy those. Let's sell those. The 70s. It's 70, so 67, 67.50. So we got about $1 to run on those. Is the idea that this will expire worthless? No, it will not expire worthless. There's always going to be value in this because the market is going to move. We don't want this to expire I mean, if it expires worthless, it would have to really nail the number, I would think, for it to do that. And if you did it for a credit, then you would be happy, I'm sure. But no, the idea is obviously to make money and have it move. So these calls are going to be deep in the money, hopefully. Anybody else have any other questions? I explained that all good for you guys, like how Vega volatility we don't have to worry about. We don't have to worry about the theta decay, decaying these options because they're going to decay at the same rate for the most part. You know, once it starts getting super deep in the money, the theta is going to be off maybe by a penny or so, but we're not worried about that because, you know, we're making that up in spades by the market direction. So I'm not going to worry about a couple of pennies falling off the table. But I do want to make sure I write down my exit, whether it's a loser or an exit for a profit, before I set this up, you guys. Write all that stuff down. Why you're bullish, why you set this strategy, why you picked the certain strikes you did. Write that down because maybe I got a credit for it and it was actually made it so I could buy it cheaper than where it was trading and stuff like that. What is the margin on the put? And that's going to be different for just about everybody. You know, if you're doing this in an IRA, it's going to be pretty hefty. It's going to be almost like a stock, but in a margin account, it is basically, I think they take it to the 1 standard deviation. So if we're looking at this, you're probably going to go to 35. They're going to get you for about $35 of margin. Does that make sense? Do I have an indicator for a broad market trend change? Other than you know, Steve Primo has a couple of them, and he has a platform that does it. He's part of Pro Trader Strategies as well. I look at his stuff a lot, but for market changes, I usually just look at the charts. You know, I've been looking at the charts, it seems like for so long. I think I'm getting pretty decent at it. I have a tendency to look for big moves like this, and I probably would have gotten in on a short right here before this green candle. I don't wait for the confirmation, unfortunately, a lot of times, but I generally look for candles like this at the top of a big move. And I probably would have gotten short win here had I seen it, you know, not around those earnings, but and played that to the downside. Can you do a fib on win? Absolutely. Do I have a fib up? Yeah. It's going to be dirty. I don't really look at it super in detail, but that's pretty good. You can see it's going to want to bounce right in here because of these volume nodes. Anytime you have these big volume nodes, that's where time and volume has been spent. That's where money's being exchanged. That's where people are comfortable. So win is probably going to want to settle down right here, which may lead me on Monday to sell puts in here rather than doing this long strategy, because it could just settle down here and just trade sideways for a little while. And I'll be able to collect that on the puts with that much high implied volatility. But for me, I'm pretty bullish on win, and even more so on probably XOM. So maybe on XOM is the one I'll be playing the upside on Monday with this strategy in the daily market commentaries that I do. I talk about, you guys, in my daily market commentaries, I talk about all my trades. Every trade I do, how they're working out, if they're not working out, when and where I'm getting out, why I'm doing that trade. And I go over all the daily market, or I go over all of the daily economic data points too, and what I'm seeing in those. So I go through all of that stuff and try and get it in around 10 minutes, but lately they've been going a little long because of earnings and I've been doing so many trades. So, but I'll probably look to do this XOM on Monday for the upside. And I'm going to look at it on these, you know, I already sold puts in there, like I said, and they're the 80 puts. So I got in a little early, but I'd probably be looking at doing something like this, the 85s, buying these and selling these only because that's really the closest to 85, right? Get a credit of $1.50, so 85. Is that right? I'm getting a credit of $1.50, so I'm getting these for 83.40 something, so a lot less. 84, 83, 40 something. So I'm getting this up way less. Does that make sense? How do we get your Monday webinar? Wally, I don't do a webinar on Monday. I just do webinars on Fridays, but every day of the week, I do daily market commentaries where I talk about every trade, every strategy, every time I'm trying to defend a strategy when they've gone long, what earnings trades I'm doing, all of that stuff. And but how do you get that? You can sign up for it. You can just reach out to us at trading@protraderstrategies.com. I've always picked up a Wolfman nugget or two from your webinars. Thank you, Barshit. I appreciate that. Bob, appreciate it. So you guys, this is what we're doing for this week. We're doing a deal for you guys. It's basically how to trade options like a Wolfman. There's over 20 videos here. For 36 bucks, you can't beat it. And one thing I say all the time is always continue your education. And obviously you guys have done that by attending this webinar, but that's the best way to get comfortable with these things is continuing your education. I go through all of that stuff in these webinars, how to set up your screen like I do, how to trade the market profile, option protection, or protecting your portfolio with options, and protecting your portfolio against rising interest rates. This is huge. For 36 bucks, you guys, this alone, this one webinar, you guys, is going to save you $36 in this rising interest rate environment, because you can't chase yield, which is you can't chase a higher coupon on a bond. You can't say, well, this coupon's paying 6% and I'm getting a 4% one. I'm going to go buy that 6% one and dump this 4% one. That 6% bond coupon, that extra 2%, is never going to make up for your loss that on the value of those bonds that you actually sold out in the market. It can't be done. And I show you how to kind of set up your portfolio to make it so it will increase your coupons in a sense. So that one alone is great. This one's really fun, the history of options. But over 20 videos, great deal. I teach how to trade options using probabilities. And you heard me talking about the probabilities of success with this strategy here. The synthetic long stock is 50-50. I talk about all the probabilities and how to be mechanical. So, anybody can go out there and teach technical analysis or how to build a strategy, but not everybody is going to be talking about the probabilities like I do and how to stay mechanical, stay in the game. Anyone can build a strategy. You can go out there online. I'm not going to lie to you and say you can't find how to do a long synthetic stock strategy online. Yes, you can, but they aren't going to go through these details as to how to set it up so you get 100 deltas and some of the other little floor trader hacks that I throw in there. So bottom line is, when you guys are using the right tools for the right situations, you guys are going to be more productive state of mind, and you're going to be able to put on more strategies, which creates more opportunities and ultimately builds your confidence, therefore increasing your overall yield in your portfolio. So we're offering this today. So I suggest you guys, sorry, somebody's already hit me up. It's not in the chat window. It's in there now. I think I just sent it out to all of you guys in the chat window. So you can just click on that link right there. We're talking back and forth in the questions box. There's another little section that says chat, like to members and stuff like that. So I put that link in there. If you're watching this on tape delay tomorrow morning, you can just pause this and punch this into your URL and take advantage of that. So if you've learned anything at all from me today, you guys should be trading with this knowledge. So what do you say? Go ahead and click on that link, or you can call us at 310-598-6677. Email us at trading@protraderstrategies.com, especially if you want to sign up for the the daily market commentaries, that's not a part of this deal here. You can ask them about that. We can get you set up with that. Are these videos online or CD? Wally, these are online, and it's really great because where this little box, this circle is, there's actually a box. So you can click on, I've watched that, or you can resume where you left off, things of that nature. So you can just go through, and if you can skip all around, and it's not like, if you watch this one over here and came back over here, well, have I watched that? Yeah, I've watched it. No, you check it off when you're done, and it's really easy. All right. Is there a link for this? Yeah, it's in the chat window. So we've talked back and forth on the questions. There should be a little chat window over there on the whatever they call that thing. It says chat. Just hit the side arrow. It should extend it down, and you'll be able to see it in there. Wally, the daily market commentaries come with a package, so I don't just do the daily market commentaries, but you can talk to those guys. It's a subscription, and you basically get all kinds of other stuff in there. All right. Last thing, I just want to thank you guys all for attending. And later webinars, I'm going to be drilling down on option components, when and where I find trades, and when I find them appropriate. Here's also the link. It's also not a hyperlink. You're going to have to pause and write it down. And thank you all. If you have any questions, reach out to us at 310-598-6677 or at trading@protraderstrategies.com. All right, go ahead and hit away. Thank you. I appreciate all the kind words, you guys. Thank you. This $36 special for the video is good until the end of the weekend, basically, Wally. Otherwise, thank you guys all for all the kind words. I appreciate it. I'm not going to go through and read all this stuff for a vanity metric here, but I do appreciate. I just want you guys to know I appreciate you all and your kind words. I think I got everybody. Thank you, Harry. Appreciate it. You got the package? Good. Reach out to me. Let me know if there's anything that I like constructive criticism too. So I'm not just somebody that wants all the accolades. I want somebody to tell me what I'm doing wrong so I can fix it so that the next person doesn't have that same issue. All right. Happy Super Bowl weekend to you too, OM. Appreciate it. Cool. Thank you. Thank you, Harry. Appreciate it. All right, guys. Have a great weekend. And if you can't take that, take it easy. JQ in the house. All right, guys.